Good day, ECO152 students. We're continuing with part 2 of your chapter 7 slides. We are on slide 7 of the chapter. Well, you know that from chapter 3 that government finances its expenditure from taxes, amongst other things. You also know from chapter 1 that taxes are a leakage in the circular flow model. In this section, we introduce taxes and denote it with the letter T. Taxes reduce the income that households have to spend on goods and services. We say that taxes reduce the disposable income, YD, of households. Disposable income is thus YD equal to Y minus T. By reducing disposable income, taxes indirectly reduce consumption spending by households. Next, you have to ask yourselves, what determines the level of taxes? There is a systematic relationship between the level of taxes T and the level of national income Y. Think about what happens when our income increases and the relationship with taxes. We have to pay more income tax. Similarly, think about VAT and company tax. We assume that taxes T are a certain proportion of income, and this proportion is called the tax rate. The small t in this formula represents the tax rate. So, if we do a little bit of manipulation, we can see that disposable income YD was given by income minus tax. Of course, we have to pay tax before we receive our salary in our bank account. While the tax amount is given by the tax rate multiplied by Y. So if we substitute this into the formula over there, what we get is disposable income, Y is equal to Y minus TY. And if we collect our terms, we can rearrange such that YD is equal to, in brackets, 1 minus T, close bracket, Y. Right. So let's move on. We have to now understand how taxes impact the multiplier, the equilibrium level of income, as well as aggregate spending. So since tax is a leakage from the circular flow, the introduction of tax means that a smaller proportion of any addition to aggregate spending will be passed round in each round of the multiplier process. The introduction of tax thus reduces the size of the multiplier. We can summarize that the introduction of a proportional tax thus leaves autonomous spending unchanged. It reduces the multiplier, alpha, and it will reduce the equilibrium level of income, Y0, ceteris paribus. We will evaluate all these outcomes shortly. In this figure, we have a simple example of the economy as a whole. We are given a fixed tax rate or a proportional tax. Here the tax rate is given as T equal to 0.2. We thus have T, capital T, equal to the tax rate 0.2 times Y, which means that 20% of the total income in the economy has to be paid to government in the form of taxes. It follows that when income Y is 0, then T will also be 0. And when Y is equal to 500, then T would be equal to 100, which is equal to saying 0.2 multiplied by 500 gives us 100. The slope of the curve is the tax rate, small t, and that is equal to 0.2 in this case. Thus, in this diagram, we would have had taxes on the vertical axis and total income on the horizontal axis. And the function that has been graphically illustrated is T is equal to our tax rate times national income. Let's examine how taxes affect spending and income in the economy. We have just seen that taxes will reduce disposable income of households. You must therefore distinguish between what is total income Y and disposable income YD. We will now have to modify our consumption function to show that households cannot spend their total income, but rather their disposable income. To show this, substitute total income Y in the consumption function with disposable income YD. So note, in the figure on the top, we have our consumption function given as autonomous consumption plus our induced consumption, and here we have total income Y. However, we now have to replace that with disposable income YD to reflect that households cannot spend all their income. Right. So now this function becomes C is equal to C bar plus CYD. And by virtue of the fact that YD from the previous slide we saw was equal to, in brackets, 1 minus TY, we can substitute that into our consumption function. When you plot the consumption function, consumption spending must be on the vertical axis or y-axis, and you're plotting it against total income Y on the horizontal axis. The steeper curve in this figure represents the consumption function without taxes. That is this one over here. Note the slope is just given by the marginal propensity to consume C. And the flatter consumption function includes tax. So if we have a look at this function over here, note the slope now is C, which is your marginal propensity to consume, and multiplied by, in brackets, 1 minus T. So here our slope has become flatter by the inclusion of tax. The vertical intercept, C bar, is the same for both curves. So note that with the introduction of taxes, the consumption function swivels downwards. However, autonomous consumption C bar has remained the same. So let's quickly recap before we move on to the figure below. Here, in our original consumption function, we had only consumption and we did not include taxes. However, when we included taxes, this was done by including YD as opposed to Y. And YD was given by 1 minus TY. Thus, the slope became flatter and changed from just being the MPC to becoming C in brackets 1 minus T. And now our consumption function is C is equal to C bar, our autonomous consumption, plus our marginal propensity to consume multiplied by, in brackets, 1 minus TY. Our next step is to include the government sector as a whole and to see the impact of both taxes and government spending on the equilibrium level of income. Graphically, the effect of the introduction of the government sector can be illustrated in this figure below. The original aggregate spending curve over here, before the introduction of government, is given by A1 equal to A bar 1 plus CY. The intercept is A bar, where A bar is equal to C bar plus I bar, and the slope of this function is C, the marginal propensity to consume. The initial equilibrium of this function is given by E1, and at this point, the equilibrium level of income is Y1. Right? So this is our initial aggregate spending function before the inclusion of government spending as well as taxes. Note the difference between this A1, versus this A1 bar. This A1 bar represents the autonomous component C bar plus I bar for your simple two-sector model. Right. When government spending is introduced, G, there is a parallel shift upward of the aggregate spending function to A2. So note, when we introduce government spending, this curve over here shifts upward in a parallel fashion to become A2. So here we have A2 is equal to A2 bar plus CY, right? So now we see that our intercept, our vertical intercept, has become higher. It is now A2 bar, and this intercept is the culmination of C bar, I bar, and G bar. The slope, however, remains the same because it is a parallel shift. So hence, here we can see that our slope is the same. And if we look at our equilibrium level of income, we now have a new higher equilibrium at Y2. So note the magnitude of the change. An increase in government spending given by this shift over here resulted in a greater change in the equilibrium level of income from Y1 to Y2. Now let's see what happens when we include taxes. So now we need to shift our attention to the function, the aggregate spending function A3, which is equal to A2 bar plus C in brackets 1 minus Ty. So what is different in this function? Well, if we draw a comparison between A2 and A3, we can see that the vertical intercept is still the same as A2 bar. So this is still given by C bar, I bar, and G bar, all the autonomous components. However, if we compare A2, this aggregate spending function, with A3, we can see that there's been a pivot or swivel downwards as a result of the slope of the curve changing with the inclusion of the tax rate. Thus, we now have our equilibrium level of income being Y3, lower than before. Let's look at the model algebraically so that we can solve for the equilibrium level of income. So thus far we have the disposable income YD, and we saw that it is equal to, in brackets, 1 minus Ty. We also saw that we have to modify our consumption function to include disposable income now. So thus our consumption function becomes autonomous consumption plus our marginal propensity to consume, and instead of it being Y, it is now YD, and YD was equal to 1 minus T, those brackets, Y. Thus, at equilibrium, we know that A is equal to Y, and we know that our aggregate spending function now is given by C plus I plus G. Thus, by substitution, we now have our entire consumption function, as well as our investment spending function and government spending function equal to Y. So now, by virtue of being able to do a bit of rearranging, we can say that our equilibrium level of income Y is equal to C plus I plus G, but we would like to collect all the terms that have a Y on the left-hand side. By doing so, when we take this entire term over to the left, the sign changes and becomes negative. And all that we're left with on the right-hand side is our autonomous components, C bar, I bar, and G bar. And this represents the total autonomous spending. Now, if we collect these terms, if we just rearrange this slightly, what we are left with is 1 minus C in brackets 1 minus T. And if we take that over to the right-hand side, it becomes the inverse. So thus, our equilibrium level of income Y0 is equal to the multiplier, or alpha, multiplied by our autonomous components in brackets C bar plus I bar plus G bar. Right? And in so doing, you can calculate your equilibrium level of income, Y.